You're watching Cash Flow on CNBC, first in business worldwide.
All right, welcome back. Let's get back out to our guest host this hour, Kimber, Managing Director at Kimber Capital, sitting down in Sydney studios. Chris, at a time when a lot of fund managers are saying it is best to be in cash because there's just so much volatility out there and the supposed easing hasn't happened and may need to wait until September, why are you saying Telstra may be one of the bets around?
Yeah, well, because cash rates, it's just ridiculous to be in cash. You just can't, people can't live on it. The bulk of my clients in Australia are running their self-managed super funds, and they're not trying to trade the market day to day, headline to headline. They're trying to live off this. Now, one of the best performing sectors of the Australian market over the last 6 months has been our dividend yielding stocks. And Telstra, last year in October, when the index hit its low, 38,900 was trading at about $2.80. We talked about it on CNBC. It was come 3 dividends. It was yielding 15% fully franked, which was nearly a 20% return for a 13-month investment. We're now sitting not that far down the track. They've paid 2 dividends and the stock's rallied from 280, hit a high of 405. Now, what's happening at the moment is a lot of money from Europe has come into Australia chasing some of these dividends, and the reason our index is off today is because Telstra reported the other day the Aussie dollar nearly hit 107, so now some of that money is coming out because they can't take advantage of the franking credits in the 14-cent dividend that Telstra is going to pay in around about 2 weeks. So Telstra's fallen from 408, 409 down to $3.80, but at that point it's yielding 28 cents over the next year. So with the capital return there, with the dividend yield there, round about 10%, doesn't make much sense trying to get 3.5%.
Yeah, makes sense. But still, we also had a downgrade from Credit Suisse just a short time ago, saying that they're moving it down from neutral, from outperform to neutral, saying it's pretty much at fair value. So why get it now?
Yeah, and look, I think they're probably right. The market is very, very split. We've got 2 or 3 major brokers that are now valuing Telstra between $4.85 and $5.20. Credit Suisse could keep a neutral on it and at $3.80. What I've done with my clients is that we were way overweight Telstra. We sold half of our Telstra stake just because of the large capital gain that was in it. But if people are sitting on large amounts of cash, so if you're sitting in cash here at 5% and you're paying tax on that money, then Telstra at $3.80 with its franking gives you 10%. So you may as well hold your Telstra shares or buy them at $3.80 rather than wait and look for something else to do. Plenty of opportunities that are in the market, far better than sitting in cash.
Yeah, but that said, we've also been wondering whether the defensives, the usual suspects, the telcos and the pharmaceuticals, aren't they already a crowded place?
Yes, they are a crowded play, and I think as we talked with Oriel on the show the last couple of weeks, we've actually been reducing our exposure to that sector. Ramsay Healthcare, our healthcare stocks have done very, very well. Our telco stocks have done very, very well, and our 4 major banks, where a lot of people out of the US were trying to short, waiting for a residential property crash in Australia, which has never occurred, have all rallied dramatically. Commonwealth Bank's another big one. It's come from $45 up to $58. If you were coming to the market now, much harder to buy these stocks at these prices.
Okay, Indy, we'll talk more. Well, thank you so much for that, Chris Kimber. Plenty more from him coming up as we head out for a short break.